58% of India's 1 billion people are under the age of 20. This young workforce gives it an edge over economic rival China, where the one-child policy will see the working population age over the next 2 decades. But young workers also put a heavy burden on India's government to create over 8 million new jobs every year. Despite its efforts at attracting foreign direct investment, India still gets only a fraction of what China gets.
The fact that we attract only a fraction of what China attracts in terms of FDI have disabled us from efficient exploitation of India's biggest competitive advantage, namely a young workforce that will grow over the next 20 years than decline. FDI has worked wonders in China, and I believe FDI can work wonders in India.
That's what the finance minister was telling the World Economic Forum's India Economic Summit in New Delhi. He certainly had a high-profile audience. Global heavyweights like WPP, Microsoft and Toyota were among the more than 600 participants from nearly 36 countries.
There is a broad consensus among foreign investors that the Indian economy will grow from 6 to 7% for the next few years, as its fundamentals are strong. But for 8% growth or more, it will have to focus on improving certain key areas, the most important of which is infrastructure.
The International Monetary Fund believes India's economy will grow by 7.1% in 2005. Its Prime Minister thinks 10% growth is realistic in 2 to 3 years' time. And leading the charge are India's top companies. Their earnings growth has averaged more than 20% annually over the past 3 years. This is attracting interest from overseas investors and international bankers.
Indian companies themselves are looking to the international financial sector more than they have done in the past, and we have to be there ready to respond. And we've been particularly pleased this year that we've introduced a number of Indian corporates to the convertible bond market.
The key to jump-starting India's growth is its agricultural sector, which was previously not considered a commercial opportunity. Today, the new buzzword is agribusiness. The German trading and retail group Metro entered the Indian market in 2003 with 2 cash-and-carry stores. It now wants to expand into 4 more Indian cities. It believes that sourcing farm products directly from farmers will help boost the sector.
Modern retailing is managing the supply chain back to the farmers and invest there into the supply chain. Cooling capacity, packaging capacity, that's all about modern retailing, and it will help to develop the rural area. And you have to know that in India, 600 million people live still in the rural areas.
An estimated $150 billion will be needed for infrastructure development in the next decade. The big question is where this money will come from.
This is a big push for India. If India does urgently mobilize funds, both from the public and the private sector, to enhance infrastructure, not only in terms of physical asset, but also in terms of procedural matters, trade facilitation, logistical supply, that would give India a strong push towards the full benefit of being a more open economy.
China remains a challenge though, even if India has a looming demographic advantage. India will need to push advantages like stronger intellectual property laws to give it an edge. And foreign funds are already buying into the India story. They've pumped $8.5 billion into India's stock markets this year, driving them to new highs. The 30-share benchmark index of the Bombay Stock Exchange, the Sensex, has grown 46% since April.
India is still relatively small in terms of the world as a whole. But in some areas, India already has some leverage. If one looks at what drives oil prices, the growth in energy demand comes out of China specifically, but also from India. And if one looks 15 years down the road, India will be big. And India will be shaping developments globally.
For that, product innovation is important. India is hoping to leverage its skilled manpower base to become a global technology center that is both high quality and low cost. If that happens, a growth rate of 10% wouldn't be out of reach.